As traders and investors, we have to be prepared for both the best case and worst case scenario. And in today's video, I'm going to give you an exercise that I just found out about this morning, and I think it can help impact your trading and investing in a positive way. Check it out.
Shed yourself of the day.
What's going on, everyone? Jeremy Ritz here. Courage pays better than fear trading. And today I was watching Squawk Box on CNBC. Go ahead, make fun of me, but I do enjoy watching that. Joe Kernan, Andrew Sorkin, Becky Quick, and then Squawk on the Street with Kramer. Everybody hates on Kramer, Carl Quintanilla, all those guys. They had a guest on, and I can't remember his name, so forgive me. He talked about the current state of the markets. We are at all-time highs. We're extended. We're at a top. We haven't had a meaningful correction in quite some time. The panel was asking him, what do you do to be prepared for risk? He said, I always ask myself the question, no matter how good things are, if there is a crash, what happened to cause it? It forces him to identify risks in the market that maybe people aren't thinking about. So even when things are good, he's asking himself the question, okay, 6 months from now, there's a crash. What would be the reasons for that? And so that's something that I heard and I was like, you know what, that's brilliant. Let's stop, let's pause. Let's take a look at everything that's happening in the markets. Let's take a look at inflation, the labor market. Let's take a look at earnings, all those things. And if we do get a crash in 6 months, what would be those things right now that we're seeing, the canary in the coal mine, if you speak, that are telling us that there's weakness and potentially we could see a crash? And this doesn't mean that a crash is coming, or it doesn't mean that we need to trade or invest in fear. It just means that we need to be prepared for whatever those scenarios and outcomes could be. And that's why this exercise is super helpful. But you can also flip it. And so let's say that we're in a downturn, which eventually we're going to get a correction. Eventually we're going to get a bear market. It happens. It's the stock market. But asking yourself the question, if you're short or you're being defensive in that type of market, 6 months from now, a year from now, what is it that caused the upside, the busting of that bear market so that we flipped and we went back into a bull market? What are those things that caused that to happen? Was it an increase in earnings performance? Was the expansion of AI across multiple sectors? And so doing that type of exercise in a bear market can help prepare you for and be ready for the flip in the trend change. And so ultimately the takeaway here today is, as traders and investors, we always have to be reflecting. We always have to be evaluating ourselves, evaluating the market, and considering the scenarios that exist out there, the probabilities, bull and bear alike. And I want you to take this exercise and reflect. Right now, we're at all-time highs. Market sentiment is up. We're expecting things to go higher because of the rate cuts. But if in 6 to 12 months from now, we did have a crash, what would be those factors that have caused it based on your understanding of the markets, the economy, everything that's happening right now? And think about that. And when you have that identified, you can then prepare and protect yourself, your trades, your investments, your portfolio, so that if that does happen, you can weather this storm. And so I wanted to share that with you guys today. Let me know your thoughts. If we do get a crash in 6 months, what would be the thing that caused it? Put that down below in the comments. I will see you back here for the next video. Make it a great day, everyone.
Collectively find your